Welcome everyone in the Finance for Engineers course. In previous lecture, we have started Unit 2nd, where we had discussion concerning to financial analysis. You must have understood that financial analysis of a company may be performed for a variety of reasons, such as valuing equity securities, assessing credit risk, conducting due diligence related to an acquisition, or assessing a subsidiary's performance. Financial analysis tools can be useful in assessing a company's performance and trends in that performance. It also helps in analyzing and converting data into financial metrics that assist in decision making. Analysts seek to answer such questions as how successfully has the company performed relative to its own past performance and relative to its competitors. How is the company likely to perform in the future? Based on expectations about future performance, what is the value of this company or the securities it issues? Thus, analysis of financial statement reveals important facts concerning managerial performance and the efficiency of the firm. Broadly speaking, the objectives of the analysis are to apprehend the information contained in financial statements with a view to know the weaknesses and strengths of the firm and to make a forecast about the future prospects of the firm, thereby enabling the analyst to take decisions regarding the operation of and further investment in the firm. The various techniques used for analyzing financial statements are comparative statement, common size statement, trend analysis, and ratio analysis. Further, we discussed about comparative statement and solved an example on preparation of comparative balance sheet, where you must have understood that as a result of application of comparative technique, it is possible to find out not only the balances of accounts as on different dates and summarizes the different operational activities of different periods, but also the extent of their increase or decrease between these dates. The figures in the comparative statement can be used for identifying the direction of changes and also the trends in different indicators of performance of an organization. Now, let us see the next example, which is concerned with preparation of comparative income statement. This is an example. Second, following is the profit and loss statement of BCR Company Limited for the year ended March 31st, 2014 and 2015. That means here again, we are going to see the data for 2 years, 13-14 and 2014-15. And this is a vertical income statement. So here revenue from operation is given, that is nothing but a sales revenue. Add other income, that is the income earned by the company from other sources. Addition of the two is written as total revenue less expenses. Here they have given a total amount of expenses for the 2 years, then profit before tax, and then they have deducted tax from the profit and arrived at profit after tax, that is PAT. So this is the information given concerning to BCR Company Limited, and you are required to analyze the financial statement by using comparative technique, as well as it is expected that you should give comments on the performance of the organization. So already we have seen how to solve or how to prepare comparative statement. Columns will remain same as we have used in preparing comparative balance sheet. So let us see the solution of this example. So this is the solution. Here we need to write again on the top company's name in whose book you are writing this statement. So in the books of BCR Company Limited, comparative income statement for the year ended 31st March 2014 and 2015. First three columns are as it is given in a problem example. Then we have added two more columns, that is absolute increase or decrease in a rupees. And then the last column is concerned with a percentage that indicate the percentage change, whether it is increased or decreased. So in last lecture already I told you that if the amount decreases or percentage decreases, we have to mention it in a bracket. So let us see one by one. So here first is revenue from operation. In 2014, the amount is 60 lakh. In 2015, 75 lakh. Absolute increase is of rupees 15 lakh. And when we convert it into percentage, it is 25%. Then in the same format, we have to apply the same formula for all the figures, and we calculated absolute increase or decrease for each line item mentioned in a particulars. And thus we found that other income has decreased, and in a percentage it has decreased by 20%. So except this other income, all the figures show increase in it. So at the end of the statement, we found that the profit after tax figure shows absolute increase by 3,98,500. That means in percentage, 35.03% increase the particular company has achieved when compared with earlier year. So this is a good achievement, one can see, that is increasing profit by 35% when compared with earlier year. Definitely, it is a good achievement, good performance of the company. So now it is expected that we should give comments on all the figures. So let us see the comments on this calculation. So here, first comment is the growth in revenue from operations is good. Second is other income has reduced by 20%. Total operating expenses has increased by 15%. Though there is increase in a total operating expenses, the company has recorded substantial increase in profit before tax. 46.29%, and profit after tax 35.03%. So this is the comment on the performance of the BCI Company Limited. So whatever we see, I already told you that whatever is important, we feel that it is important to mention, we have to give as a comment and should give suggestion to the company if required. Okay, so let us move further. Next point of discussion is common size statement. This is the another technique used for analyzing the financial statement of the organization. It is also called as vertical analysis, and it is a tool that manager use to analyze financial statement. It evaluates financial statements by expressing each line item as a percentage of the base amount for that period. The analysis helps to understand the impact of each item in the financial statement and its contribution to the resulting figure. This facilitates comparison of two or more business entities with a common base. Thus, common size analysis is of immense use for comparing enterprises which differ substantially in size, as it provides an insight into the structure of financial statements. Interfirm comparison or comparison of the company's position with the related industry as a whole is possible with the help of common size statement analysis. So here you can see the comparison, regular profit analysis of company A with company B, and on the other hand you can see common size profit analysis company A with company B. So definitely by looking at the graph, one can easily understand that the performance of company B is good as compared to firm A. While in regular profit analysis, we may not come to know that whose performance is good. We will see only the revenue. The firm A revenue is good, but the profit is less, but it is not visible. It is not easily visible to us that the compared to revenue, profit of company A is less. And from B, revenue is less, but compared to revenue, profit is good. But when we compare it by using common size profit analysis, we come to know that the revenue of the firm B, though less, profit is good. So this is a beauty of this common size statement, which gives us an idea, real picture. One can understand the actual performance of the organization. The management efficiency can be seen by using this common size statement analysis. And formula for calculation used is percentage of base is equal to amount of individual item divided by amount of base item into 100. There are two types of common size statements. First is common size income statement and next is common size balance sheet. The first is common size income statement. This is one type of common size statement where the sales is taken as the base for all calculations. Therefore, the calculation of each line item will take into account the sales as a base, and each item will be expressed as a percentage of the sales. This is very important thing in case of common size income statement. All the income, all the line items are compared with the sales. The ratios tell investors and finance managers how the company is doing in terms of revenues, and they can make predictions of future revenues. Companies can also use this tool to analyze competitors to know the proportion of revenues that goes to advertising, research and development, and other essential expenses. Next is common size balance sheet. A common size balance sheet is a statement in which balance sheet items are being calculated as the ratio of each asset in relation to the total assets. For the liabilities, each liability is being calculated as a ratio of the total liabilities. Common size balance sheets can be used for comparing companies that differ in size. A financial manager or investor uses the common size analysis to see how a firm's capital structure compares to rivals. They can make important observations by analyzing specific line items in the relation to the total assets. For example, if the value of long-term debts in relation to the total assets value is too high, it shows that the company's debt level are too high. Similarly, looking at the retained earnings in relation to the total assets as the base value can reveal how much of the annual profits are retained on the balance sheet. Let us see the importance of common size analysis. One of the benefits of using common size analysis is that it allows investors to identify drastic changes in a company's financial statement. This mainly applies when the financials are compared over a period of 2 or 3 years. Any significant movement in the financials across several years can help investors decide whether to invest in the company. For example, large drops in the company's profits in 2 or more consecutive years may indicate that the company is going through financial distress. Similarly, considerable increases in the value of assets may mean that the company is implementing an expansion or acquisition strategy, making the company attractive to investors. The second point is common size analysis is also an excellent tool to compare companies of different sizes but in the same industry. Looking at their financial data can reveal their strategy and their largest expenses that give them a competitive edge over other comparable companies. For example, some companies may sacrifice margins to gain a large market share, which increases revenues at the expense of profit margins. Such a strategy allows the company to grow faster than comparable companies because they are more preferred by investors. So these are the importance of common size analysis. Next is example. Let us start with an example. So from the following information, you are required to prepare common size financial statement for the year ended March 31st, 2014 and 2015. This is again an income statement. So it starts from net sales, deducted cost of goods sold, then arrived at gross profit. From gross profit, operating expenses deducted and received operating income less non-operating expenses, and finally profit. So amount is mentioned in a rupees. Now next is they have given also the balance sheet of the same company. In the sources of fund, shareholder fund, which comprises of two things, share capital and reserve and surplus. Second point is borrowed fund, that is long-term borrowing, and the addition of two, that is shareholder fund and borrowed fund, is total capital employed. That is a liability side. That is the various sources the firm has used for raising funds. Next is application of funds. That means the firm has invested the funds in these various assets. Under that, you can see three important points. First is fixed asset. Under that, two headings are there. First is plant and machinery, that is tangible asset. Next is goodwill, which is intangible asset. Then the second point is non-current investment, that is nothing but a long-term investment. And the third point is working capital, nothing but current asset minus current liabilities. So in this way, they have presented here application of fund. You can see here total capital employed is calculated for application of fund by the addition of fixed asset, non-current investment, and working capital. That is A minus B, current asset minus current liability. The amount of total capital employed is same for sources of fund and for application of fund for both the years. That is, in 2014, it is 26 lakh, and in the year 2015, it is 22 lakh. So by looking at these figures, we come to know that there is a decrease in a total capital employed amount of this particular company. So now it is expected that to prepare a common size statement. So let us see how to present this data in a common size statement, how to calculate the percentage change. So this is a solution. You can see here, as the company's name is not disclosed here, we are just writing it as a in the books of ... Okay, so there is no company's name. Then common size income statement. for the year ended on 31st March 2014 and 2015. You can see here the data presented and the procedure followed for preparing this common size statement. Here, first we have listed out all the particulars, that is net sales, less cost of goods sold, gross profit, less operating expenses, operating income, less non-operating expenses, and profit. Then in second and fourth column, you can see the amount which already given us in an example. We have presented in a second and fourth column. 2014, we have mentioned all the figures, amount concerned with the particulars. And in a fourth column, again, we have mentioned the information concerned with the amount related to the particulars. Then we have chosen a common base for calculation. So here, in case of revenue statement or income statement, net sales or sales revenue becomes a base for calculation. That is, in case of income statement, you have to keep in mind that in case of income statement, always net sales or sales revenue becomes a common base for calculation. And in case of balance sheet, the total capital employed or total asset amount becomes the base for calculation. Okay, so now first we will see income statement. So here it is visible that net sales amount is written as 100 in a percentage to net sales column. So already on a top we have written that percentage to net sales. That means we have calculated all the percentage figures by taking net sales as a common base. We have made clear on the top only. Okay, so percentage to net sales and then net sales become 100. So first see the third column. First we will calculate the third column, that is concerned with the year 2014. So 25 lakh is equal to 100. Okay, so now 25 lakh has become 100 base for next calculation. Then cost of goods sold. How to calculate that percentage? We have already seen the formula, that is the amount of that line item, that is 12 lakh divided by the base item, the amount of base item, that is 25 lakh into 100 will give you percentage to net sales, that is 48%. Likewise, we will calculate for other line items, that is for gross profit, operating expenses and all. So by this way, we will calculate the figures, percentage. Once we complete the calculation of 2014, we will move to the year 2015. Again, you can see here, though the amount has changed of net sales from 25 to 18, base remains same. That means again we are considering that 18 lakh as 100. We are converting that 18 lakh into percentage as 100. We are taking it as a base for next calculation. So again on a top we have written percentage to net sales and then apply the same formula, and by applying same formula, how we will calculate 10 lakh divided by 18 lakh into 100. So it will give you 55.56%. In the same way, the base will remain same and the only line item will change. That means for calculating gross profit figure, what we will do, 8 lakh divided by 18 lakh into 100. That will give you 44.44%. For next operating expenses, 80,000 divided by 18 lakh into 100 will give you 4.44%. So likewise, you have to apply the same formula for calculation. Base will remain same. So we will be able to understand that how much amount has spent on various activities when compared with net sales. So it is percentage to net sales. And here we can see that at the end, profit figure in the year 2014 is 46.60%, while in 2015 it is 39.33%. That means it has decreased. As the base is same, we can easily say that there is a decrease in a profit. And then further moving, we can see the change in cost of goods sold. Yes, there is increase in the cost of goods sold, and it must have affected on the profit of the organization. So this is about the common size income statement. Let us see common size position statement. The balance sheet statement is also called as position statement. So here, this is for the year ended on 31st March 2014 and 2015. Same columns you can see here, particulars, amount column of 2014. Next is percentage to total capital employed, that is the base for calculation. Then again, next year 2015 and percentage to total capital employed. So by this way, we will present our data. We will do the comparison. This is a standard format for preparing common size balance sheet statement. So share first, it is the sources of funds, and under that first is shareholders fund. And we have presented 2014 and 15 data concerning to amount in a second and fourth column. Then percentage to total capital employed. So what is that? You can see at the end of the sources of fund statement, 26 lakh for the 2014 year is 100, and 2015, 22 lakh, we have converted it into 100. That becomes the base for calculation. Formula we will apply here, that is base item. Here we have to keep in mind is total capital employed, and the formula to use is line item amount divided by the base amount into 100. That means 15 lakh divided by 26 lakh into 100 will give you 57.69%. So in this way, we have to calculate for all the other figures. as like income statement. Here, total capital employed will become the base. It will not change. So in case of reserve and surplus, how we will calculate? 5 lakh divided by 26 lakh into 100 will give you 19.23%. So in this manner, you have to complete the calculation for 2014 for sources of fund, then move to 2015 sources of fund. 22 lakh is the base, and that's why converted as a or written as a 100. Then for share capital, how to calculate? 12 lakh divided by 22 lakh into 100 will give you 54.55%. Same, 5 lakh divided by 22 lakh into 100 will give you 22.73%. So in this way, you will complete the calculation of sources of fund, then move to application of fund. Now here, same title you can see at the end of the application of fund statement, that is total capital employed, 26 lakh and 22 lakh. So 26 lakh in 2014 become 100. For 2015, 22 lakh become 100. And then calculated the percentage to total capital employed for the year 2014, then for the year 2015. So by this way, we able to prepare or present the given information into common size statement. And by this statement, we can understand the position, financial position of the organization. We can see that share capital has decreased compared to earlier year. Reserve has increased. Again, there is a decrease in the long-term borrowing. Then moving to application of fund, there is substantial change or decrease in plant and machinery figure percentage. Also, the goodwill has decreased. Investment show increase in it. Inventory increased. There is decrease in a trade payable. So in this way, we can easily compare the 2 years data, as there is a common base for comparison. Now the next is, this is the next example. From the following information, you are required to prepare a common size balance sheet of the Tata Group companies as on 30th 9 2015 and 2016. And here you are required to comment on the given information. So here they have provided you the balance sheet statement in a T format, that is liability and asset. Liabilities are presented on a left hand side and asset on a right hand side. 2 years data they have mentioned: share capital, reserve and surplus, hybrid perpetual securities, non-current liabilities, that is nothing but borrowed funds we can say, and provisions, Next is current liabilities. On a asset side, you can see non-current asset in that fixed asset and other non-current investments, loans and advances mentioned. And next point is current asset. So in this way, they have given the information concerned with asset and liability position of Tata Group of companies for the 2 years. At the end, we can see total equity and liabilities and total asset figure are same. And it is expected that you should prepare a vertical common size position statement and comment on the same. So let us see how to convert this data into common size statement. Yes, this is a solution in the books of Tata Group of companies, common size balance sheet as on 30th 9 2015 and 2016. Here we have not mentioned earlier data but directly presented the percentage. But the thing common remain here is total equity liabilities of 2016 written as 100. That is the base for calculation. 2015 again at the end total equity and liability converted to 100. In case of asset, total asset for both the years mentioned as 100. So that is the base for calculating the percentage of the above figures mentioned as liabilities or assets. By using the same formula, we have calculated here the percentage of share capital for the year 2016 and 2015. And by looking at the figure, we can come to know that yes, there is increase in certain items. That is, share capital has remained same, but there is increase in a reserve and surplus. In 2015, it is 56.7%. In 2016, it has increased to 58.3%. Securities show decrease, that is from 2%, it is now 1.9%. That means it must have redeemed. Next is long-term borrowing, again show decrease. That means the company must have repaid the loan. So by this way, we can compare the figures in between the 2 years and we can comment on the happenings of the organization. What must have happened at that particular point of time can be understood, can be judged. Now, moving to the asset side, we can see here there is increase in a fixed asset, but there is a decrease in a investment. Then there is increase in a current investment and decrease in inventory. So by this way, we can comment on the financial position of the organization when we convert the data into a proper format by using common size statement. We can easily compare the information of first year or earlier year with the current year. So let us see the comments on this common size balance sheet statement. So here comments are reserves marginally increased by 2% when compared with the year 2015. It means profitability must have increased. As we know that the reserves are from profit. Next is long-term borrowings have decreased by 1%. This means that some marginal repayments of loans must have happened. Then there is an increase in short-term borrowing by 1.7%. Inventory level remained almost same. Next, there is a marginal increase in trade receivables. And next is the share capital remained the same, which means there is no fresh issuance of capital. So in this way, we can comment on the income statement or balance sheet statement if we convert it into common size format. So here I'm ending my session, and in the next lecture we will continue with the another techniques used for analyzing the financial statements. Thank you.